Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, that being said, they are European-style exercises, which means that although you can buy and sell these options at any time throughout the life cycle or the expiration cycle of the option, you don't have to worry about somebody coming in and exercising or assigning you to fulfill your obligations on those options. There is nothing that can happen until the third Friday of the expiration month. The expiration is noon because obviously the currency market is a 24-hour market. There needs to be a standard time, and of course, again, cash settled in U.S. dollars, so you're not going to be receiving the equivalent in a different currency. You can also trade these options as spreads. There are a number of different strategies. We're going to talk about one of them this evening, but recognize that you can trade these options by creating various spreads, bull call spreads, bear put spreads, credit spreads, condors, butterflies, all sorts of wonderful strategies that we've talked about in the past, and we'll certainly moving forward we'll be talking about in the future. But recognize that trading options on these currency pairs, on these FX options pair values, allows for a lot of flexibility when you're looking to create a specific type of position for yourself. And of course, if you're looking for more information, www.ise.com/FX, and as Steve mentioned, there's some really great tools there to help you get a little better understanding of this market and to track the pair values on a day-to-day basis. So that being said, of course, as I mentioned, these FX options, we're really looking at trading them in the same approach that we would look at trading an equity option. The difference, of course, is that if we expect the U.S. dollar to strengthen against the other currency, we would buy call options. So if we're looking, for example, at the U.S. dollar versus the Canadian dollar or the CDD, if we think that the U.S. dollar is going to strengthen, the Canadian dollar weaken, then we would buy calls. And again, that gives us the right to buy the U.S. dollar at a specific price over a specific time based on its value against the Canadian dollar. And of course, the opposite of that, if we expect the U.S. dollar to weaken, then we would go in and buy puts, which give us the right to sell at a specific price and for a specific time. And remember that these ISE-FX option pair values are cash settled, so we don't have to worry about taking a different currency. They're cash settled in U.S. dollars. So we have really three general rules of thumb that we look at when we're selecting an option contract, and we pretty much keep it the same when we're looking at creating a directional bias, whether we're looking to buy calls or buy puts, and whether it's we're looking at an FX option pair value or whether we're looking at a standardized equity option. The one thing is that we always look at our price charts. So we always establish a directional bias using our price charts, and we also establish key targets, because recognize that, of course, your options values, your premiums, are going to always reflect the value of the underlying security. So although there are a number of different variables that impact how that option contract is going to trade, and that goes for the ISE-FX options pair value, as you trade into these key support or resistance levels, we have to recognize that the option contract can conceivably be influenced quite dramatically by a change in direction of the underlying security. So we want to take that into consideration when we're looking to lock in our profits or, of course, manage our losses. So everything starts with our price charts, but of course, when you're dealing with currencies, you also want to be aware of any major economic announcements that are coming out on a day-to-day basis as well, that are of course going to influence the pair values as the information is made available to traders. Now, the second thing is that we want to give ourselves 2, preferably 3 months until expiration. Now, that doesn't mean that we're interested in holding the position for that long, but the one thing that that is certain is that these markets have a tendency of taking the trader on a little bit of a roller coaster ride. And when you're dealing with an option contract, which is of course a depreciating asset, we have to worry about time depreciation. That little bit of a roller coaster ride might be just sufficient enough for us to run out of time. And so consequently, the more time we give ourselves, the more chance we have at being correct. So although we may look to offset a position within a very short time frame, sometimes 2 to 3 days, we want to give ourselves a couple of months just in case we don't see a lot of movement or we get a little bit of a move in the opposite direction before it takes off in the direction that we anticipated. Now, we also want to use an option contract that is close to or at the money. And what that means is that we're looking at the value of the underlying. In this case, it may be, the CDD, which is currently at 121. I believe it was 121.80. And we want to look at that and say, okay, I want to control this pair value close to where it is right now, and that way when it moves in the direction that we've anticipated, then right off the bat we're in a situation where we're going to be profiting. But of course, if it takes a little bit of a detour, the closer we are to the current pair value price, the more chance we have at the market turning around and coming back into our favor. So I look at it as a measure of probabilities, and the closer that I'm trading the current that I'm controlling the current pair value at, the higher probability that I have of it maintaining its value over the life cycle of that option contract. Now, generally, we'll look at a delta of no less than 30, and I might be talking a little bit more advanced for some folks online. What we'll do if it warrants is maybe we'll come back with another presentation on some of the options Greeks, but recognize that we want a delta of, generally speaking, of no less than 30. Again, that tends to give us a few strike prices outside or close to the money. So it gives us a chance to buy an option contract at a reasonable price, controlling it slightly out of the money, but at the same time putting us close enough that we're comfortable with the probabilities of us having made the right decision. Now, moving forward, we talk about a few things that we want to consider. First of all, as I mentioned early on, our pair values will not increase or decrease in a straight line. Although we've had some pretty close to that moves with these pair values as of late, recognize that generally speaking, the market does not move in a straight line, and so we have to be prepared to be taken on a little bit of a roller coaster ride from time to time. And generally, what we want to do is just, of course, recognize that initially we might be on the wrong side of it, but because we've planned our trade out effectively by looking at our price charts and recognizing key support and resistance levels, that we can sit back and sort of let this roller coaster ride play out as long as we remain within the within the time frame that we've allocated, and of course within the support or resistance levels that we've allocated as our sort of our lines in the sand in terms of cutting losses if the price action happens to move outside above or below. Now, the one thing is for certain is that we may be correct on the direction, but we might be wrong on the time frame, and so we have to again be in a situation where we know how to adjust our position just in case we're a little off with our observations.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.